Hey YouTube, James Baker CPA here. In this video, I'm going to give you some background about U.S. estate tax laws and how they apply to non-residents, when and where they apply. And more importantly, in the video, I'm going to go over the forms in case you have a simple situation and you want to complete it yourself. I don't advise this, but if it's a really small situation and you want to do it yourself, go for it. That's why I'm making the video. Complete the forms with you, show you where to file them, give you the number to call if the IRS is taking too long to process the forms, and give you a timeline of what to expect after having done this for, I mean, almost 50 people now. And it doesn't sound like a lot, but 50 is a lot. These are all very unique situations, and I can't find anyone else online doing the Form 706 NA non-resident estate tax forms. I have other videos about this, but as I've been doing more and more, this is going to be the best one yet because I have more experience than I had before. I have 6 stages in this video. I'm going to go over what is subject to estate taxes in the U.S. and who's subject to paying estate taxes. I'm going to why is this tax assessed and what's the filing for. You need a transfer certificate. Number 3 is what forms need to be included and how to complete them. Number 4 is how long it takes. Number 5, how to contact the IRS. The short answer is if you've already filed, it's 866-699-4083. And number 6, the last one, how to avoid this from happening to you. What is subject to estate taxes in the U.S. if you're a non-resident? This means if you live outside the U.S., the only assets that are generally subject to estate tax in practice are going to be brokerage accounts and real estate. And it makes sense. They're located in the U.S. So if you have a brokerage account, and more specifically U.S. stocks inside of a brokerage account, those are subject to estate taxes. So often what happens to me is a client will call me from Mexico. He said, my mother opened a brokerage account in Wells Fargo 30 years ago and bought a lot of Apple stock, and she recently passed away and I can't get the funds out of the account because they say I need a transfer certificate. And unfortunately, this is subject to estate taxes and we have to file the forms and get the certificate. That's what this whole video is about. The second kind of person has real estate with some kind of mortgage on it. They say the broker that I can't get the title transferred because I don't have a transfer certificate. And a transfer certificate or a tax clearance certificate, there's 2 different kinds of forms, but it's a certificate you get from the IRS showing that there are no estate tax liabilities on this asset because you filed these Form 706 NA. Those are the most common things. Sure, corporate stock in the US is subject to estate taxes. Sure, bank accounts with cash from an active US trade or business is, but those are uncommon. It's really going to be mostly brokerage accounts and real estate. It's assessed because it's an estate tax on just assets. There's an estate tax for Americans as well, but the exemption is like 14 million right now. No, it's like 11 million right now for Americans. I can look up the real number, but I'm not going to. It's like over $11 million for a single person in the US, but for a non-resident, the exemption is only $60,000. So if you had assets in the US, which is stock or real estate, with a fair market value, a date of death worth of over $60,000, it would be subject to this estate tax. And we're going to go over the rates, but it's up to 40%. It's a very high tax. So let's go to the forms now. Okay, so you can get access to these forms on the IRS website. If you Google search this, Form 706 NA, you can find the website. You can see the current form and the instructions for the form. The instructions are extremely useful, and they're going to tell you step by step on how to complete the form. I'm not going to go through the instructions. I'm just going to look at the form with you. The top is informational. The decedent is the person who's passed away. First name, last name, U.S. taxpayer ID if you have one. If you don't have one, it takes a little bit longer. And after you file the forms, 2 to 4 months later, the IRS will send you a letter assigning you a tax ID. Place of death is going to be literally where it happened. Domicile, the time of death, very important. It's basically where the person was living. Citizenship, the nationality, you can put multiple if there's multiple. Name of executor. This is generally going to be the person who's managing the process, the trustee. It should be named in the will. If there's no will, you put your name on it. It's a complicated process, but there needs to be an executor. This is going to be the address, and this is the mailing address. This needs to be an address you're going to have for a while. This process can take a very long time. I have a client that I filed this for a year ago, and then I filed it for him 6 months ago, and I just keep mailing it because the IRS is just throwing it away. They're not processing it. They're just the worst to deal with sometimes. If you have an attorney, then put the attorney information. And then it gets to the computation. The computation is actually the second part. This is part 2. So we're going to skip this and come back to the computation. The executor is the one who's going to sign the forms before they're sent to the IRS. If you're working with me, I'm going to put the paid preparer information down here because you paid me to do it. And then additionally on the new forms, I'm going to also put myself up here as the authorization to receive information. I'm going to have myself signed as a representative up here as a CPA. But if you don't have anyone, you leave this blank. Now, these are important questions. Did the decedent die testate? That means with a will. Yes or no? If they did, you need to attach it. Number 2, did the decedent at the time of death own any real property? That would be real estate. Or U.S. corporate stock, that would be like a brokerage account. Or debt obligations, less common, or other property in the United States. Personal property and cash are generally not subject to estate taxes. So just having a bank account, you should not be paying estate taxes, and the bank actually shouldn't make you do this to get it out. There's a good article by the tax advisor here, if you really like this, that came out this year in May. U.S. estate tax, not just for U.S. citizens. This is the AICPA, my governing organization as a CPA. It's a very good article, a lot of citations. It's kind of what I'm talking about. I would watch my video, and then if you want to read more about it, it's more technical there, but it'll tell you there that cash and personal property generally isn't subject to estate taxes. Okay, were they engaged in a business in the United States at the date of death? Yes or no? At the date of death, did the decedent have access to a safe deposit box? You know, these are yes or no questions. If the person who died is a U.S. person, they should have had a W-9 on file with the bank. And the domicile, the determination of domicile is different for estate taxes than it is for income taxes. It's very complicated, and you know, if you have a really crazy complicated situation with a lot of money involved, just call me. But again, if this is just for something simple and you want to try it, that's what we're here for. At the date of death, did the decedent own any property located in the United States as a joint tenant with surviving spouse's community property? This is very common. I see this often happening because people set up surviving spouse, joint tenant with rights to survivorship. They set up the companies like this, or they set up their investments like this. So if this is yes, you have to do Schedule E on Form 706. So we're going to look up Form 709 on the IRS website. And 706, I did it again. 706, and this is for an American who is subject to estate taxes. And on the 706, we're going to see all of the subforms. So you're going to have to patch together a PDF document. So you finish this form, and then you attach also the 706 Schedule E, which I'll get to, which is very common. I've had to use this often. Jointly owned property, where on here you're going to put in the description of property. You want to be as specific as possible. The valuation, you're going to split it up like the total amount, and then you have other. This is for a marital with a split with a spouse, and this is for other joint interests, because I've had it where mothers and sons are joint on accounts, and you list them down here. It's important to set this form up correct. Have you ever been a citizen in the United States? Yes or no? Did you lose citizenship or residency within 10 years of death? Yes or no? And basically, apart from these, if any of these are yes, you probably need to consult with somebody and do it professionally. Okay, did the decedent make a transfer of property before they died? Basically, did they send out their assets before they died to avoid the estate tax? Were there any trusts? Did the decedent have power of appointment over property in the United States? I've never had that happen. Were there federal gift tax returns filed? It's unlikely. Again, if you're doing that, you probably already have an attorney taking care of this. So now we're going to get through the computation. Now that you've checked all the boxes, we've gone through that, the computation here, you can elect to change the value of the property based on the date of valuation or the date of death. It's complicated, but there's a code section if you want to read it. So here's where we're going to list all the properties. If you need more spaces, duplicate this sheet and just do more tabs of these two items. A description of property and the value at date of death in US dollars. You're going to put a property, let's say 600 shares, Apple, stock, QSIP, whatever, blah, blah, blah. I don't know, but you have to put the QSIP on there. And then you say the value is going to be $1 million. And then we're going to put it right down here, $1 million. Then the gross estate in the United States is Schedule A, total $1 million. And then they want the gross estate outside of the United States, and you would share them the details. The reason is because you're allowed to deduct the funeral expenses, admin expenses, debts, mortgages, and you can only actually expense a proportion of those expenses based on your U.S. over foreign estate. So we're going to do it like this: gross estate outside the United States. We're going to say $1 million outside as well. Cold million out there. Entire gross estate is going to be $2 million, and then we're going to have funeral expenses. Let's say it was 200,000. This is an insane funeral. Deduction for claims and losses. So if you have real estate, you can deduct the mortgage expenses. You can deduct the amount of mortgage that needs to be paid as well. Well, I guess that's up here. This is where you're going to have mortgages, liens, and losses. So you have to attach an itemized schedule as well of all these things. So then you have to divide 1 by 3. It's 50%. And so you get $100,000 deduction here. Total deductions 5, 6, and 7. 100,000 here. Now we have the taxable estate is going to be 900,000, which is a huge tax we're going to have to pay. Now this goes to our line 1 of part 2, and that's the first page. So now we have 900,000 right here. Total taxable gifts are the same. This is kind of confusing. That's going to be 0 for intangible property located in the U.S. So it's going to be 900,000 right here. Tentative tax on line 3 is going to be, this one's going to be 0, and that's going to be the gross estate tax. The unified credit is always 13,000 because you get a $60,000 credit, and that's the deduction on it. So how are we going to calculate this tax? That's crazy. We're going to go to 706. We're going to do the instructions for 706. I don't think the 709 has tables in it. I've always used these tax tables. So with 900,000, it's really crazy. We have, it's 248,300 plus 39% of 750 or 900,000 minus 750. Tax line 306, 800. And this is tragic that you have to pay this after losing a family member. And the thing is, you're supposed to pay this, but you can't get access to the assets. So I'll talk about that. So once you file this, the IRS will process it. They'll send you a notice. They'll assess any potential penalties. These are due, I think, within 9 months of the date of death. They're due. Once you show that there's a balance due to the brokerage, they should cut a check from the account to pay the taxes. So that's how you actually get the taxes paid. I hope to God that if you see this, you call me and we can figure something out first. Because these are crazy situations. We're going to talk about different ways to get out of the estate taxes after. Okay, so gross estate tax is 306, 800, fine, $13,000 deduction. The balance is 293, 800, and it feels just like I'm just getting uncomfortable just like thinking about this. No, it's not here. Sorry, 293, 800. That's why I watched the whole video. Like and subscribe. Appreciate you guys for being here. Okay, total tax. There you go. 293. 800, whatever, and then we're going to put it at the bottom, balance due 293 800. Great. This is terrible. So there's a couple ways that we can avoid paying estate taxes in this situation. First, we're really going to dig into the type of asset. Are these bonds? Are they some kind of debt instrument? Are they some kind of, or is it just straight up stock? Can we confirm if you owned it or not? I've done different things with clients where especially if it's a survivorship type account, where we've positioned the contributions differently in order to position the ownership, like who owned what. And I've separated, and I've had success doing it. There's not a lot of guidance from the IRS side. So if we position it and explain it the right way and put in a letter, we can sometimes lower the tax greatly. And the last one is their death tax treaty. So I have a quick page here. There are this many death tax treaties: UK, Switzerland, Japan. A big one's Canada. It's in the income treaty, but these treaties basically allow you to use the $11 million exemption. They're all different. They're all hard to find. They're all over the place. But if a Canadian had a house or a brokerage account and they were living in Canada and they died, then you can use the tax treaty. And you're going to claim the treaty benefits on Form 8833. And you're going to assemble this return as follows. This is how I do it. I have 706 NA completed, signed, beautiful. Then behind that, if there's a 706 Schedule E, you'll have that. If there's a 706 other subschedules that you see on the 706, if you have other schedules for this, you're going to attach that. Then I usually include a letter explaining what else is attached, where I'll include the will. I'll include on the letter, I'll explain what's going on because there's not enough information on here. I'll say these were the owners, this is the tax code I'm referencing. You'll have to attach the will. You'll have to attach the valuation of the assets, and you'll have to attach, which is like a bank statement showing the value of the assets. And you'll also want to attach a summary of the expenses or the proof of any debt or other numbers you're using. And that's all going to go in one document, and you're going to mail it together where it says where to file. We're going to mail it to this address. If you're using a private delivery service, use the below address. Once you file, here's the timeline. Once you file, it's going to take the IRS 2 to 5 months to give you a tax ID if you don't have one. You should expect a letter within 6 months. If you don't hear, you can call the IRS at 866-699-4083 and talk to them. They only work like 4 hours a day. And now I want to get briefly on how to avoid this in the future. If you're investing in stocks, there's 2 ways to do it that I like. The best way is using a corporation, a foreign corporation that owns an LLC that has a brokerage account. That foreign corporation will never die, and since it's a foreign company, it doesn't pay taxes on capital gains, just like you're a foreign person. That's the one option, and that works for real estate as well, where we'll have a foreign corporation that owns a U.S. LLC taxed as a corporation that owns the property. That way the foreign corp doesn't have to pay U.S. income taxes on the rental property, but there's no estate taxes because the foreign corp will literally never die. The second best way, the cheap way, the budget way, is to have a multi-member LLC with multiple family members in it and have a really good operating agreement and kind of make sure everyone has access to the account. So if something happens to one of the members, you can change the ownership, you can sell some assets, you can move it, just kind of give everyone access ahead of time. It's not bulletproof, but it definitely works, and it's an option. If you're still here 20 minutes later looking at these forms, I encourage you to contact me. I would love to help you do these forms. I'm really sorry that you've lost someone important in your life, and now you have to deal with up to a year's worth of IRS bureaucracy and potential taxes. But it's my goal to make sure you're doing it right and that you get it done on time and you get it done correctly. And I'm hoping that this is an educational video for you to understand what's possible. After you file and you pay your taxes, then you want a tax clearance certificate. So the tax clearance certificate applies to individual accounts, joint accounts, conservatorship or qualified accounts. All these kind of accounts is you need this clearance certificate. The transfer certificate is what the IRS is going to give most people, and then you can request the tax clearance certificates on the IRS website. But this is a good site with a lot of information about it. The transfer certificate should be issued by the service when it's satisfied the tax upon the estate. So if you have less than $60,000 of assets and you're above the exclusion, you actually don't need to file the forms to request a transfer certificate. Okay, to request a transfer certificate for an estate of a non-resident, it will be issued when the service, the IRS, is satisfied the tax has been fully discharged or paid. So you have to fax the following items to this number if you live within the United States: a copy of the return, a list of the assets in which they had an interest, and then either the State Department form or a death certificate, which should go with the tax return. Okay, that's how you request the transfer certificate for the estate of a non-resident outside the U.S. And you need to have the taxes paid ahead of time. You can call them and request it as well. So I hope it was helpful, and contact me if you need help doing this. Thank you so much, and have a great day.